Good morning, everybody, and welcome to BDO's IFRS and Corporate Reporting webinar for September 2025. Today, we're talking about tricks and traps of impairment testing. Today, I'm joined by Kevin Frobus. Kevin, I trust you're well.
Dean, I'm good as always. It's good to see you again. It's spring in Sydney. I'm not sure about Melbourne, but I'm uplifted by the fact that, the heat is coming back. And yeah, it's lovely to be back here after
Great.
not being around for last month. I think you did software last month, so
Yeah, we
good,
did.
good to see everybody again.
Yeah, no, it's spring in Melbourne as well, and it's probably one of my favourite, favourite slash not favourite seasons on the basis that I do get hay fever, but you can feel the warmth coming. You can feel the days getting longer. So it's been a real pleasure to actually have the seasons to turn we can actually see. So it's been really good. Today, and I'm actually really pleased to have Kevin presenting with me today on this webinar, because Kevin has in the past done quite a few webinars on impairment testing and has good and really deep experience in impairment testing, which I'm going to test today to see where we can get to. But so we'll move right through. Obviously, you know both of us, Dean Arden and Kevin Frobus, and both partners at the BDO and our advisory group. In typical fashion, our BDO acknowledges the traditional custodians of country throughout Australia and their connections to land and sea and community, and we pay our respect to their elders, past and present, and extend that respect to all Aboriginal and Torres Strait Islanders peoples, particularly those on the call today. Couple of some housekeeping notes. Our monthly IFRS corporate reporting webinars, obviously you've joined this one, so tricks and traps of impairment testing for September. Coming up for the rest of the year, we've got next month we've got accounting for Australian carbon credit units, ACCUs, where we'll be discussing not just the accounting for it, but how they're being used at the moment, and particularly how those markets around those usage of ACCUs is developing over time. In November, we've got financial and sustainability reporting update, as we always do. We have an end-of-year reporting update for December, and in December, we've got tricks and traps of fair value measurement, which is always one that people are always very interested about, because it's the interaction between both accounting and valuation. Make a mention to our IFRS and corporate reporting experts. The key thing I probably wanted to raise here is that we've been doing quite a bit of publications, doing quite a few publications around accounting policy papers has been an area that we've been really focused on the last couple of months. And that's been from experience, not necessarily for anything untoward. It's just purely based on our experience that we're noticing that as time goes by, entities are discovering that maybe some of the accounting positions that they've agreed with their auditors hadn't necessarily been able to be sustained for various reasons. It could have been because of change in auditor or change in circumstances or just a change in economic conditions. But one of the things we have noticed is that entities are increasingly in the need of position papers, and we've done a series of articles to explain to certainly to clients and to others what we expect to see in position papers and the value of position papers as well. I might hand over to you, Kevin, in terms of the sustainability update.
Yeah. Thanks, Dean. Thanks for doing that. And yeah, I'll talk about sustainability. As you know, the way we're organized in, or at least in our corporate reporting advisory practice, is, that we've got the two traditional sides being IFRS and corporate reporting and let's say sustainability reporting. Obviously, those are both becoming quite multidisciplinary, especially on the sustainability reporting. It's linked to climate as the mandatory reporting, which is effective from the current year. And so we've got a series of sustainability webinars, but the two are linked. They both ultimately end up in the annual report. So they're pretty much complementary to each other. And why I'm kind of going on that long spiel about complementary is very nicely the two webinars will come together, or the two webinar series will come together next month, where we'll be doing carbon credits being used as part of sustainability. So essentially part of strategy and transitioning, which lines up quite nicely with the webinar we'll be doing on the corporate reporting side, which is accounting for carbon credits, which Dean just made reference to. That was by design. And just, so that'll be a nice sort of complement of two webinars to come together. the series that's been presented on sustainability report or sustainability webinars up until this point has covered the various pillars in the mandatory reporting. So the past webinars this year covered risks, resilience. We did footprint and metrics, and we'll be heading into bringing it all together for the end of the year in the next three webinars towards the end of the year. Dean, interestingly, there's really only 3 webinars left in both series this year, so that tells me spring is on the way. By the time we get to the one in December, it'll be summer, which also tells us that it's time to start planning for 2026. So what I will say at this point is, if there's anybody who has topics that you really want to see, burning desire for a topic that you'd like our webinars to cover next year, now's the time to get it in. More than happy if you kind of throw that into the comment section or the chat today. Stacey, who's our production designer behind the scenes, will kind of collect that for us. And now's the time to kind of raise your hand on what you'd like to see in 2026, so we can plan that out. Let's get into it. The last slide, which I think is on the next slide, is just the remaining masterclass that we have going for this year. So Aletta has been running these virtually for the last couple of months. I think she actually did one a couple of weeks ago, the September one. So the last one is for December. So now is the time to register for the final carbon accounting masterclass for 2025. There will probably be some variations of masterclasses next year again. They will start to change tack because we're moving from preparedness into actual reporting now. So I think there'll be a bit of a change in the flavor of the way we do our masterclasses next year. But carbon accounting is one of the base performance measures for all mandatory sustainability reporting. Not only is it all about data processing and actually, recording your emissions, but it actually links back to transition risk in your climate risk assessment. So it's quite foundational. So if you haven't already registered for that, please do so now for the 3rd of December one. That will be our final masterclass for the year virtually. And then, like I said, there'll probably be a series of them that we'll go to market on closer towards the end of the year for our 2026 season. Right. Before I forget, the checklist. One of our key pieces of collateral out in the market right now is our climate-related disclosure checklist. So it is a corporate reporting checklist. It's meant to link to the S2 disclosures that will be in the mandatory sustainability report. It's actually a wonderful piece of collateral that Alessa and the team put together, and we're beginning some traction in the market. So what this will help you with is essentially to identify your readiness across governance, strategy, risk management, metrics and targets, and also some of the general compliance. It's not just a disclosure checklist. It's a little bit more than that. It actually is a compliance checklist in a way. So it'll help you essentially evaluate the extent of preparedness in all those areas in terms of compliance, uplift required, and so forth, as you can see right now on the screen. And it'll allow you to do that by way of an assessment criteria and essentially looking for the systems, process, and quality of information behind each disclosure requirement. So the problem with S2, as with all accounting standards, when you get to the disclosure part, by then you're into just disclosing, but it doesn't necessarily tell you how to kind of build everything up for disclosure. And this checklist goes some way to doing that, because obviously everything is about information and data flowing towards the disclosure, and this will help you assess this. It also can be used to put in front of your auditors or your boards and auditor risk committees to basically, show, look, we've actually done an assessment, a partial assessment, a completeness assessment. You can then put a roadmap together to fill the gaps before your first reporting. It can actually form part of your information systems. Go to your audit and risk committee. You can go to your auditor to show where you are, and it can be a tool for essentially the last 9 yards before you get to the actual reporting. So that's available on our website for download, or you can reach out to myself, Dean, Aletta, or really anybody in our sustainability advisory practice. Names are at the back of this webinar deck, and we'll probably get to that by the end of the webinar. Now's the time. We'll be looking forward to hear from you. Right. We did that in 10 minutes, Dean. Well done.
Well done, Kevin.
So shall we get into impairment testing? So I'm going to do most of the talking today, probably. And as you know, I can talk. So I'm going to kind of get loose on the impairment topic. Dean is going to add his knowledge and experience along the way. And I think also we've got some questions that came through from the attendees in preparation for today. So we'll try and address as many of those as we can along the way. But going back to basics, the way we're going to do it today is actually just talk about impairment as a concept and then talk about some of the structural elements to put this together. Now, before I kind of get into the slide deck, I just want to make reference to the fact that we have an enormous body of reference material on BDO's website already in relation to impairment. We have a very detailed IFRS in practice, which is essentially BDO's global guide on impairment. I think we do have that towards the back of the slide deck as well. You can click a link to go and get that. It's a wonderful piece of collateral. It has been updated for the 2025 year, so I think it's been updated for latest developments. But we also have a series of webinars, articles, and other type of thought leadership material that over the years has accumulated on our website. As Dean made reference to it, I've kind of done this a few times now. I think Dean's done a few impairment webinars. I know Alette's done a few impairment webinars. So probably the way to look at today's webinars is to see that in the context of everything else that we've done in this topic. So what I've tried to do is not repeat, shall I call it, a lot of the technical we've done in the past. I've actually tried to shift the topic a little bit towards how do you make this actually practical in your organization, and we'll talk about it that way. But the first thing to kind of come to is what is impairment as a concept. So this is just a reminder, and I couldn't help but co-pilot this when I was kind of preparing this. So this is a screen grab just straight out of Copilot or AI about, tell me what impairment is. And I actually loved the answer because it's exactly the way I think about impairment. Impairment, we get caught up sometimes in things like recoverable amount and all these terms, but we actually kind of forget what we're trying to achieve here. And very importantly, the base concept in accounting is that the carrying value of the asset essentially represents future economic benefits. It's at least what does the asset expect to bring back to the business? That's what an asset is, or a resource on the balance sheet. So if you have an asset of $100 on the balance sheet, the base concept of that is that $100 represents value, future economic benefits that are going to come back to the business. So what an impairment concept is to test whether those future economic benefits, that $100 in my example, actually holds water. And the way value comes back to the business in the form of an asset is really by using it or selling it. You either use the asset and generate cash flows, or you sell it and generate, proceeds from disposal, or a combination of both. And while I like the answer from Copilot is that it pretty much nailed that. I read the first sentence and I was like, yes, you've got it. So I like that. Now, there's probably a few technical anomalies on this slide which maybe aren't exactly correct, but at least it captured that base concept. And that's what impairment is about, is I have an asset, it's got a carrying value. Does that carrying value represent at least the value I'm going to get back to the business at a minimum? Hopefully that asset will generate more than that number. If it generates more than that number, great, you don't have impairment. But if the future value coming back to you in the form of cash flows from sale or use is less, well, then you've got to write it down. That's the base concept. And there's two ways to measure it. It's the higher of the fair value, less cost to dispose, or value in use. Most organizations will use value in use as a concept because if you could sell the asset for more than you could use it, then why don't you just sell it? That's kind of the concept. Now, it's not as simple as that, of course, but I did have a client once where if they'd literally sold every asset individually, they would have made more money than just the value and use calc. And I kind of casually said to them, why don't you just sell everything? Because it'd be better if you just sold it all. And I kind of got some back about I don't understand business or something like that. And then 3 months later, they liquidated the business because it turned out that's exactly what the easiest answer was. And that's a great example of impairment at work. It's like, well, what's the best use of this asset? What's going to be the best answer? As I said, not as simple as that, but that is what we're talking about here is, does this asset or combination of assets generate me a value in cash flows into the future? And is that more than what its carrying value is? That's really what we're on about. The other concept that I want to really kind of point out here is It's about the asset carrying value that you're testing. So the most important thing about an impairment test is we're not trying to justify someone's job or whether the strategy of the business is correct. And so if everyone gets really excited when we do impairment testing, that the discounted future cash flows that we use for value in use doesn't represent the future strategy of the business and all this stuff. And that's because they lose sight of that this particular test is actually testing the carrying value of the asset. It's a very specific thing we're doing here. We're not testing the resilience of the business or the resilience of the business strategy. What we're testing is whether the asset carrying value can be justified. And so what you're actually trying to do is test whether the asset value or the asset we have can actually generate the cash flows we think it can. Some organizations will do they'll have an asset, it's worth $100, and they'll say, yes, but if we generated 3 times the volume from that asset, then it's fine. But I'm like, well, that asset can't generate 3 times the volume because the asset can only generate what it can generate. Its utility is what it is. It can't be more than it is already. We're trying to test what it can do efficiently, and so there might be a disconnect sometime between what the organization thinks it wants to do going into the future and what that asset is capable of doing as an asset. We're trying to test what the asset on the balance sheet can reasonably generate cash flow wise. It's essentially embodied utility. What is it capable of generating efficiently? That's what you're trying to test. Now, that may not align with the future strategy of where the business is going, and that's fine. We just need to bring it back to what are we trying to achieve? We're trying to test the ability of that asset and its efficient use to generate future inflows, and it can only generate what it can generate as an asset. And that's why sometimes the cash flows don't quite align with the future vision of the business, because that's its purpose. I don't know, Dean, if there's anything you want to add at that point before we kind of get into the into the nuts and bolts.
Oh, look, the only thing I wanted to add was one attendee question was, where's ASIC on this impairment testing at the moment? Now, I had a quick look through this morning through their media publications over the last couple of months, and there hasn't been anything much that ASIC has published, but you need to be aware that asset valuation and impairment testing have now become a part of their enduring areas of focus. And so they are just there every year. So I would imagine by the end of this month even, you're probably likely to see some media releases from ASIC around impairment testing and the challenges that they've put to companies, particularly listed companies, around the carrying amounts of their assets. So notwithstanding it's been relatively quiet over the last couple of months, I suspect that they're probably going to be picking up their media profile pretty quickly.
Okay. That's a good point. All right, let's go. So this webinar is tricks and traps. So I had to make up some tricks and traps. So the first trick is, how does the asset make money? Or it's all about how the asset makes money. Now, you will see today that I'm moving quite towards making this evaluation exercise in a way, or at least a setup of evaluation exercise. It's not evaluation exercise in a sense like you're valuing a business. It's essentially a valuation exercise in that you're using valuation concepts to measure future cash flows to then test against the carrying value of the asset. That's what we're doing here. But it is actually how about the assets make money. So I'm going to use a couple of examples in the first instance of some of the areas we keep running into where organizations misapply the concept because they don't link it back to how does the asset make money. And this is essentially about the setup of the test. So we're going to test the carrying value of the asset at the year end. How do we actually set the test up before we start throwing numbers and cash flows against it? Have we actually set up how this asset makes money, and have we conceptualized how this asset makes money in order, or group of assets, in order to then actually set the test up properly? Now, this comes out of our IFRS in Practice guide. So this is one of the publications that's on the website, but I also chose it because leases seems to confuddle a lot of people. I think it's because we still think of leases to a large degree as operating leases under the old lease standard. So we want to treat them as sort of some operating thing. but then we capitalize leases on the balance sheet as right of use assets with lease liabilities. So I think the broad concept of leasing hasn't really matured in the market yet. Lots of people are still confused by the concept. And the flow on issues likewise also a problem. So let's look at this one first. Now, lots of reading on the slide, but I will summarize the fact pattern for you in the interest of time, and you can go and have a look at this yourself later. But basically, we have an entity that has a leased office building with 5 floors. It's a single contract, but there's 5 floors in the contract, which is not unlike BDO in Sydney and probably in Melbourne and other offices. We've got, we lease and we have floors. Each of those floors has a kitchen and access to lifts and so forth, and we pay a fixed lease payment for the whole lot. The business has changed, and what's happened is this entity doesn't have use for all 5 anymore, so they've sublet 2 of those floors. The entity is still profitable, but what they're finding is that those 2 floors that have now been sublet are being sublet for less than the payment we're making as a lessee on those floors. So we've got what feels like an impairment coming because we're paying more for the lease of those 5 floors individually, let's say, than the 2 floors are being sublet individually. Hopefully that makes sense. Everybody happy with that? So the question that we have is, how do we set this up for success? What this case study attempts to do is actually design the test in such a way that you actually conceptualize how each floor makes money. So the first question here is, do you test this right of use asset, which is the asset on the balance sheet? So that's the one we're testing. The right of use asset will be made up of the lease payments we're making on the 5 floors because we're leasing the 5 floors. But clearly there's an indicator that one of them or 2 of those floors might be impaired, or maybe all of those floors might be impaired, because the lease we can collect as a sublease is less than what we're paying ourselves. So the right of use asset is the one that's sitting on the balance sheet that might be impaired. So the first thing you need to look at is, how do you actually create the test, or how do you build the test up? And the key question we keep running into on this one is the right of use asset one asset, or is the right of use asset each floor of the building? Now, each floor in this case is actually tested as a separate lease component and is capable of being a separate lease component for the purpose of the test because of the way it can make money and because of the way it does make money. Now, that's a very common way of saying the leases can be separated in each floor, partly because they don't belong or depend on each other, and also because the lessee can benefit from those assets or those floors individually. And a quick way to test it is this. Each floor has its own access to the lift. Each floor has its own access to a kitchen, probably has its own toilets, can be separated from the others, so it's not dependent on the others. And also you can see that we can earn sublet income by leasing those out. So clearly we can actually disaggregate our right of use asset into those separate lease components and then test them individually. And what's really important here is then how do we do the test, which is really on the next slide. And the next slide basically says is 2 of those floors are already generating cash inflows by themselves, largely independent from all the other assets in the group. And therefore, in terms of how this asset generates cash inflows, we actually are generating cash inflows, rental income from the sublease of the 2 floors we're subletting. And those will then be tested very differently in terms of their recoverable amount than the ones we're continuing to use, because the ones we're continuing to use essentially will be grouped together with all our other assets to test whether the cash generating units of the 3 floors we're using essentially form part of the business as a whole, or as the cash generating as a whole. And the 2 floors we're subletting, those generate already rental income by themselves, and we'll basically test them separately, almost like a fair value method or a rental income method. So this is something we see quite a lot, but you can see here already that even before we get to the test, the 2 sublease floors could or may even be impaired because obviously we're earning rental income less than what we're paying out for those. Whereas the other three floors actually could easily not be impaired, because when you add them together with all the other assets and treat them as corporate assets to the test, we may be doing fine on a value and use basis because our business is thriving. And I actually said that in the fact pattern, is that the entity is quite profitable at the moment. And you can actually see then that how those lease components, those floors make money, is actually the driver in terms of how not only we set the test up, but also how the impairment might arise from there. So Dean, on this one, I know you see this a lot as well. Any comments you want to make at this point?
Yeah, one thing, this is an interesting fact pattern, and I've seen it a couple of times, and probably something that's not quite necessarily related to the impairment side of it, but when you see these types of leases where all the lease levels are connected, you need to be wary of the fact that sometimes to try and remanage those leases, you have to actually cancel the whole lease. And some of the conversations I've sort of had with clients around these kind of scenarios has been, well, how do I, if I've got an agreement with the lessor that I'm going to do something, doesn't that mean that the asset's still okay? Like, I'm going to be able to manage the liability, and at some point in time, I'm going to modify the lease. But the lease liability and the lease asset are subject to different requirements once they're out in the real world. And the asset has to be, it's only going to be modified if the agreement is actually modified. So it's really subject to impairment at that point in time.
It's really good. And by the way, if you have internal staircases, that changes the fact pattern as well, as we've discovered with some of our other clients, because then we start having dependent and highly interrelated floors. So tread carefully with the fact pattern. But the fact pattern was really just to set up the fact that your test for impairment follows the way the asset makes money. That's really important, which is also demonstrated by an example too. Now, we were actually going to, well, these were actually set up as polls. I don't actually think we set the polls up to run them, and in the interest time, we'll jump out of it. But I'll kind of take you through this one. This generates the concept that when you set up your test, when it involves a group of assets or cash generating unit, the way you set your cash generating unit up is to treat it as the smallest identifiable group of assets that generate cash inflows that are largely independent of the cash inflows from other assets or groups. So this is following on from the previous example. Our three floors that we were using in the lease example would be tested along with all the other assets in their cash generating unit, because we don't generate cash flows from the three floors we were using by itself. We add them together with all the other assets in the business, and that's how we make our money. We make the money as part of a business, and that's what we call either a cash generating unit or cash generating units. The way the testing is done, and this is especially true when you're doing tests with intangible assets and goodwill, the assets that are used together with the intangible assets and goodwill need to be added together for the impairment test into cash generating units. And that's always the smallest identifiable group of assets that generate cash inflows. Notice inflows. So you need to generate money for the test to be run. So you can run a DCF or something along those lines. This one actually is a BAS company, and I actually always struggle with this one because I think it could go either way depending on the facts. So this is a demonstration of the concept, but the answer could actually be easily different if you change the facts. But I'm going to actually work through this one because I think it's important to demonstrate the concept. So we have an entity D, it's a bus company, and it provides services under contract to a local government. This is actually quite pertinent to a number of clients in the service sectors in and around the country. So we got buses. The service contract with the local government stipulates that a minimum service has to be provided on each of the 5 separate routes. So the routes are separate, but you still have to do a minimum service. So number of routes, probably have to run the route a certain time, and the buses have to be clean to a certain standard. And the assets are devoted to each route, and the cash flows from each route are identifiable. So you've got buses that can be devoted to each route, and the cash flows from each route are identifiable. 4 of the routes operate a profit, and 1 of the route operates a significant loss. So how should entity D estimate the recoverable amount of each of the 5 separate bus routes? Now, it's a trick. The question is kind of muddled a little bit, so I'll restate the question in a way that if we were running the poll, I would have asked it. how should entity D estimate recoverable amount of each of the 5 separate bus routes? Is it you do the test at the bus level, the bus route level, or the 5 bus routes together? You can see the problem here because we're trying to test how do the asset or assets generate cash inflows? How do we make money from these? And this is also an example. I think it's also out of the IFRS in practice. And if we were running the poll right now, I could almost guarantee you that we would get a mix of answers spread through A, B, and C, although I think a lot of people would go for the bus routes as the option because each of the bus routes are generating cash flows separately. The assets are devoted to each route. And so you'd say, well, those assets on each route are the group of assets that generate the cash inflows, and they're the smallest identifiable group. But the part of the definition that can't be overlooked is the second part, which talks about largely independent of the cash inflows from other groups. And in this case, those buses serve one government contract, and we're unable to curtail really the five routes, even if one of them is unprofitable, because the independence of the cash inflow is governed by a single contract with government, stipulating minimum service on each of the 5 bus routes. So if you look at the answer to this one, it'll actually be that the smallest identified group of assets that generate cash inflows that are largely independent of the other groups actually is at the group of 5 bus routes together, which is slightly higher than if we did each of the bus routes individually. Change the fact pattern ever so slightly, remove that interdependency away from the bus routes, and the answer would be different. And you'd be running the test at the level of the bus routes, or maybe even at the level of the bus, depending on what the facts are. So it's very important in the setup to be really clear on how the asset or assets together make money, and very importantly, the dependencies and interdependencies of those assets, because you can get the wrong answer if you don't set it up properly. Right. Either I've blown everybody away, and maybe you as well, Dean, but let's move on to some bigger and brighter concepts. So assuming we've set up our test properly, we've grouped our assets together, it's all about how the assets make money together. So, how do we group them, the smallest identifiable assets and the interdependencies? We now actually have to go do our testing. And as I said, testing almost always involves a DCF. That is especially true if you're doing value in use and value in use of a group of assets. So your so-called value in use at a CGU level. And that introduces the concept of forecast period, cash flows over a number of years, terminal value, and discounting it back to a present value. This on the screen is pretty much how most impairment tests would come to us, because somewhere in the standard it talks about that an organization would essentially forecast out their cash flows from the group of assets, but the forecast period shouldn't be longer than 5 years. I think that's the wording it used. It shouldn't be longer than 5 years. But you still need to capture in there the ability of that asset to generate cash flows beyond the 5-year period up to its useful life, because assets will be used beyond. That's what we call the terminal value. And so the terminal value will often capture the year 5 cash flows with a growth rate factored in, and then you'll discount that back to present value. Very much like a valuation type exercise. But the valuation is curtailed a little bit because the purpose of this isn't to value the asset, it's to do an impairment test. So the purpose is somewhat different to evaluation. So this isn't necessarily the amount yet that you get from this test isn't necessarily what somebody would buy the group of assets from you for. That would be fair value. This is a value in use in terms of what is the utility of this group of assets if we use it on an efficient basis? What can it generate for us going forward? So your value in use might look something like this when you're doing it. And we see we've got some historical actuals in red leading up to a budget period in year 1, the column in the middle, B 2022, that's my budget period. That period in this case is actually the forecast budget that the client has prepared for their next financial year. That budget's gone through a management approval process, and then the forecast periods beyond that, being 2, 3, 4, and 5, are not actual budgets of the company. They are just estimates into the future, so we call them the growth periods, with a terminal value at the end. So this is pretty standard in the impairment world. And then what this has done is it's basically compared the valuation or the present value of this at a discount rate to the assets in the CGU to come up with in a bit of a headroom, in this case at the bottom. So that's pretty standard. I think in terms of this, I just want to kind of point out some good practices of impairment modeling at this point. You don't have to do it this way, but on the next slide, Dean, I've just got some kind of little thought bubbles on some of the good things we see. Often good to have historical in there, starting at the top left-hand side and going anti-clockwise. It's just some thought bubbles. Show the historicals for comparison, because at the end of the day, this can be built up over time. If you're doing annual forecasting, make sure you use midpoint discounting, because you're doing annual, not monthly or quarterly. Make sure you use a discount rate for market uncertainty in the cash flows. Every cash flow model technically has uncertainty in it, and if you're building in the uncertainty into the cash flow, you shouldn't build in the uncertainty in the discount rate. But that is what the discount rate is in a way. It's to essentially build some uncertainty into the cash flows. The idea of this is to get to free cash flow from the operation of the asset. So you really shouldn't be dealing with equity and debt at this point, because debt structures and equity structures are unique to the entity, whereas what we're testing is the ability of these assets to generate cash flows operationally. So you should be doing things like interest and so forth in this, but you should be making adjustments for working capital and capex and so forth. As you can see there, you need capex and working capital to support the operations. This is actually one of the questions we get a lot. I actually think I think there was a question before we came here: do you include depreciation in the terminal value? I think the question was. But basically, the question is, where do you include depreciation in your value in use calc? Now, the interesting thing about this is that depreciation is often added back from, let's say, your profit and loss, and then deducted again in terms of capex to kind of represent that you need to keep maintaining the assets, or you need to be investing in capex to support the operation. That is absolutely true. So should you have depreciation in the cash flows? No. But you do need to have something that looks like capital to support the operations, and often organizations will say, well, my depreciation and my capex are kind of the same thing. One replaces the other, and that is not always appropriate. In fact, it's not appropriate, especially if you have growth in your revenue. So in this model, you can see we've got growth rates of 22% and 9% and 8% in my forecast there. There's no way my depreciation and my capex would actually be equal to each other in that case, because you'd probably need more capex to support that level of growth. So hopefully that answers the question. Don't leave taxes out, even though the standard says that you should be using pre-tax. Nobody does that, but you do need to keep it consistent, because you do have to pay tax on these cash flows to get to a free cash flow model. And you do need to build growth rates into the model. But very importantly, and this is actually the key point of this section, you should not be using growth rates that aren't reasonable and supportable. In other words, if your forecast period that is subject to management budgeting processing hasn't been subject to some sort of testing of the ability to budget and forecast, your growth rates should be heading very quickly back to long-term average rates. And this is a quirk of the accounting standard, is that really beyond the budget period that management has approved and beyond the budget period that management is capable of forecasting, you should not be using something that is outlandish. You should be looking at something that is reasonable, supportable. Normally external information is what you're looking for there. So what generally happens is the budget period in my DCF year, which is column in the middle 2022, that's often management's approved budgets that have gone through a rigorous budget process. You've tested that. It's aligned to the business strategy, and and it's been built up and subject to sort of scrutiny, the periods beyond that, it becomes very difficult to use the growth rates of 22%, 9%, 8% year, especially if those are significantly bigger than the growth or the long-term average growth rates of in the industry you're working with. And IFRS favors the use of external long-term growth in the period beyond the budget period of management, because it doesn't trust management to be able to budget in that period. So that's all that's happening there is beyond your budget period and forecasting period, you really got to say to yourself, are those growth rates reasonable and supportable? And if they do not align with external long-term growth rates in the sector or the industry, you got to say to yourself, how supportable is that? And that's really, really, important. And those are the key building blocks. Don't you have anything to add on that front at this point, Dean?
Oh, just to absolutely agree with it. The long-term growth rates are like they're almost the hook that you will be caught by if they don't match what your past experience is or what you can actually demonstrate in your industry or for your particular entity. It'll be the thing that, because they have to be disclosed, there'll be the things that will be immediately identified as assumptions. And I suppose to your point, Kevin, all the assumptions are subject to challenge. Obviously, if you were ever to be asked by ASIC or your auditor, what exactly is this number, they're all subject to challenge. So they have to be realistic, they have to be tested, they have to be consistent and also reflective of what you've achieved in the past. And if management are missing the mark dramatically year after year in terms of estimates, you are going to get pushback from whether it's your auditor or the regulator or anyone on that basis.
Yeah. Which leads us into our next trick, which is actually the budgeting process is what establishes reasonability and supportability. And kind of like this slide, because it's actually talking to what I've just said in terms of multiple value in use tool. The forecast period on the left is the period where the cash flows are estimated by the entity. In other words, the entity has subjected its cash flows to some process to come up with a forecast. That's often the budget process. If an entity only budgets 1 year into the future, then that's your forecast period. And then, I'm not saying you can do what you want to, but at that point, what you're actually testing your forecast period to is you're actually testing the reasonability and the supportability of the forecast period to the process of budgeting in the business. So really, it's really how good you budget and forecast at that point, and whether you can actually rely on the controls in the business to budget and forecast, and then you discount that back. Beyond the forecast period, you're actually in the terminal period. Now, the terminal period often assumes that you've got 5 years of forecast and then a terminal value. But technically, there's nothing that says that you can't actually just have a 2-year forecast period and then a terminal value. Because what actually happens is, if your forecast period is 2 years, that's your budget period. You've got a nice budget in the organization that's been subject to, a robust budgetary process. And you're using that for your forecast period, then your terminal value will really just capture everything beyond that from year 3 onwards. So there's nothing that says you have to have a 5-year DCF. It just says that it's normally 5 years and it can't be longer unless justified. And the reason why they did that is because most organizations don't forecast beyond 5 years. Some of the big sophisticated organizations do, and I've seen them. Most organizations that are not big conglomerates or multinationals with big systems and processes really have a 2 or 3 year, or maybe even just a 1 year forecast period, and then the terminal period is just a terminal value which relies on long-term growth rates in the external market, or long-term growth rates which you can actually go and find in externally to the business. Well, this is the growth rate that I'm going to use, and that concept becomes quite stressful to a lot of organizations, because they don't want to admit that beyond their forecast period, which might be as short as a year, they're just defaulting to essentially long-term growth rates. But that's pretty much how this works. And it's not about testing the resilience of the business or the resilience of the strategy or questioning what the business is going to do beyond the forecast period. It's actually about finding inputs that are reasonable and supportable. That's what this is trying to do. So your internal forecasting period is reasonable and supportable because it assumes you've got a very good budgeting process. Beyond that, look for external long-term growth rates as your input, because that's more reliable than some number plucked out of the out of the air. And that's really what this is trying to achieve. Now, in the interest of time, I'm going to kind of keep galloping, because those were my main points. The rest of the slides in these sections are actually just to kind of support some of those concepts. This slide talks about what reasonable and supportable cash flows are. And really, it's about, these are the things that your budget process should exhibit to make your budgeted forecast numbers reasonable and supportable. You should be using management budgets that are approved by management, because the idea of that is management won't approve a budget unless it's been robustly put together. The budget forecast shouldn't be greater than 5 years, but what you're actually looking for is the demonstrated ability of management to perform and forecast accurately. In other words, if you've got a budget process and you never meet your budget, at that point, you have to ask yourself, should I even be using this budget in my impairment test? Because it's just a piece of paper. Some organizations go through 4 months worth of budget processing, and then at the end, they just change the number to what they want it to be anyhow. That is not a demonstrated ability to budget. That is just making up pie in the sky. At that point, you should probably just not be using your forecast anyhow. So these characteristics are designed because the standard assumes that you can budget, that you've got a demonstrated ability to budget, that you've done some sort of due diligence on previous budgets to make sure you understand, if you didn't meet the budget, you understand why, that you make assumptions that are consistent year to year, and it's the best estimate of economic conditions. If you're not doing a budget beyond a 1 or 2 year budget period, then at that point you default to terminal value and you go and look for other inputs that are reasonable and supportable. But these are the characteristics that your budget process should exhibit in order for you to use them as your forecast period. This then is where we get to the prohibited cash flows and under our budget processes. What shouldn't be in there? We've discussed some of these already, but the key one that we want to talk about here is you should not be including future restructurings that you're not yet committed to. And what we mean by that is, if your forecast budget that you've put together assumes you're restructuring the business, but you haven't committed to it. The reason why the standard wants you to pull that back out of your budget is uncommitted forecasts can easily be undone. Committed for restructuring you can include because you can't back out of it. So this is just sort of one really key exception is, yes, you can use your budget. Yes, your budget and your forecast probably includes things like future restructuring. But if you haven't committed to those restructurings, you need to pull them back out of your budget. Why? Because it's not reasonable and supportable to include them, because by being uncommitted, management can easily back out of it. That's the concept there. But what you can include in your future cash flows are efficiency improvements. If the asset could be run more efficiently and we need to improve that, that is permitted. One of the biggest problems in impairment testing is distinguishing between restructures and efficiency improvements. And I'd like you to pay a bit of attention to that. And that is because efficiency improvements and future restructurings in the business are often included in future budgets, but the one has to come out because you might be able to back out from it. Whereas the other one you can include because anybody is going to try and run their assets more efficiently and therefore should include those. All right. The last trap I want to deal with, and I'm going to jump over that slide in the interest of time, Dean, is what is reasonable and supportable in times of uncertainty. This is very relevant to our current situation in terms of the, shall we call it the tariff uncertainty. We're living in a world of tariffs, and what is the uncertainty? Diplomatically, we'll say there's evolving international trade policies that seem to be moving on a regular and sometimes daily basis. The way the accounting standard is set up is it actually addresses the situation. It talks about the potential for significant changes in market conditions as a form of external information that is a trigger for impairment. It's the so-called impairment indicators. Doesn't call them tariffs, but it talks about operating in an environment where there can be adverse effects from market changes. So tariffs is the topic of the day, but the standard does actually say, well, you might have an impairment trigger year if you're exposed to these in terms of the jurisdiction you're operating in, or perhaps maybe your supply chains are getting stressed, and you can work it out at this point. Is it's clearly going to impact the future cash flows. That's what this is heading to. If you're operating in an environment where your future cash flows could be impacted, then you need to factor that in. The trick here is where to factor them in. Now, once again, I gave you 3 or 4 examples on tariffs on the next slide, and the trick here is whether the tariffs should be actually factored in at all, because sometimes the tariff is threatened but not imposed by the end of the year when you're doing the impairment test. Sometimes the tariff is threatened, imposed by the year end, and then undone after year end. Sometimes the tariff is threatened, not imposed by year end, but then it is imposed at the end of the year. Post year end before you sign your financials. So it's quite a hairy situation that we're dealing in. This first example was basically, if we have a situation where you have a 30 June year end, there's a threat to tariffs by various governments which would impact your operations and your businesses and supply chains. It hasn't been imposed by year end 30 June. Should you ignore those tariffs in your value and use calculation if it hasn't been enacted or imposed by the year end? That's the key question. We hadn't set it up as an actual poll. We could have run this on a yes or no. So the question is, should you ignore it because it hasn't been imposed? And the answer in this case is no. It is not appropriate to ignore the tariffs even if they haven't been imposed by year end. Why? Because value in use is about estimating future cash flows that the assets are going to generate, but considers the range of management's best estimates of economic conditions that you're going to be exposed to over the remaining useful life. In other words, remember when we did our DCF, we had a series of cash flows and we had a discount rate. The discount rate often would consider things like market uncertainty, but with tariffs, you're actually able to factor those into cash flows more specifically. And this is where we get to scenarios of, do you factor the tariff in or do you not factor the tariff in? The answer is you must consider it and at least factor the range in. So the way you might do that is actually do a scenario analysis of cash flows. You might actually factor tariff is not imposed, tariff is imposed, and tariff is imposed but is then revised in 5 months' time. And those must be factored in somehow into your cash flows, because the range of economic conditions that are going to actually be factoring to your value use must be considered. So this comes back to, once again, how you forecast. If your forecast period, which is your budget, sorry, Dean, if you just go back one slide, actually doesn't factor the tariff in, but there's the threat of tariff, you have to at least consider how that is going to impact your budget. So you would budget stress it when you set your final budget. But if you're not actually factoring into your cash flows, then your discount rate has to factor it in. The risk of that uncertainty must be factored somewhere into your discounted cash flow. We had a couple of other tests, Dean, sorry if we just kind of jump to them, and there were a couple of polls, and like I said, we decided not to run the polls today, but they are in there, but they all have the same answer. The answer to the tariffs questions are the range of factors must be considered, and really this one on example 5 is a good way to kind of capture it. Changes to customers and vendors in terms of the cash flows must be factored in as a reasonable and supportable information reflecting management's best estimates. They must be included some way or another. They can't be ignored. The way I've seen it done, more and more organizations actually are using scenarios in their cash flows now. It's really hard to factor in uncertainty into the discount rate. It's probably better to start running scenarios 1, 2, 3, and 4, and then weighting those scenarios in setting your cash flows. And that's what the standard envisages a good budget or forecast process will incorporate, is you don't budget in a vacuum to what's happening around you. That would be factored in. you might weight it or put a probability weighting on that condition, but it must be considered in some way or form. And I am finding that a 3-level scenario is what I'm seeing more and more. No tariffs, tariffs, and tariffs that don't last very long. And a weighting is being assigned to that, because that then helps management put a proper budget together that's actually reasonable and supportable. And that's probably the sort of the key thing that I wanted to make mention there. Dean, I think anything at this point in terms of questions that we had that we might want to deal with at this point?
I don't think so. We had a few questions, and we might deal with those probably maybe outside the webinar today. But I suppose one thing I was going to highlight on that topic, certainly there's evidence certainly in other countries where the expectation of the tariff is actually being already factored into pricing, so that entities are already starting to change their prices. Suppliers are starting to change their prices. I think we saw here too with Australia. Australia Post with delayed and deferred delivery to the US as well for a period of time. I think they're back doing it now, but clearly just the prospect of tariffs was enough to cause price changes. So again, you can't ignore that. You know, whether you conclude that they're impactful or not is another matter, but you really can't just sort of say, well, they haven't been implemented and therefore can be ignored. I think I might just give you the chance to talk to the final trick or trap.
Yeah, so the final trick, I threw this in because of a question we got before the webinar. It was talking, this doesn't exactly deal with the question, but the question was along the lines of, if you do an impairment test at the interim, can you use it at the year end? I mean, the answer is there are mechanisms in the standard to rely on impairment tests done previously or done before year end. It's quite restrictive. Basically gives you 3 conditions. If you've done an impairment test at some point during the year, can you rely on it? Or if you've done one in the previous year, can you rely on it? There's different rules. The one I've put on here is you can use one in the most preceding detailed calculation in the preceding year, if and only if these conditions are met. There's no significant change in the assets that make up the CGU. In other words, you haven't changed the business, the way they make money, and the way the assets make money. The most recent recoverable amount exceeded the carrying amount by a substantial margin. Of course, substantial margin is not defined, but what they're trying to say there is, if you've got a set of assets, it makes money, and you had such a massive amount of headroom previously, if nothing's changed, you probably still have a massive amount of headroom, so you can rely on that calculation. That's what they're trying to get to here. And then the last one is the likelihood that the current recoverable amount would be less than the current coverable amount is remote, which is kind of just firming up the idea of you can use the previous calc and not necessarily update it, because if qualitatively these factors exist, then quantitatively you're probably going to have a massive amount of headroom. So don't worry about redoing the calc. Once again, though, it's facts and circumstances determined, but there are mechanisms in the standard for you to rely on a previous calculation in certain situations in order to avoid having to redo the calc itself at year end again. Just tread carefully with that. I think we'll wrap up then, Dean. I think with kind of 2 minutes to go, just to remind everybody, if you need any assistance, there's a heap of resources out there. This is the IFRS in practice I was referring to at the beginning of the webinar. I've kind of screen grabbed two things out of there, which might show you the sort of value it can provide. One is we've got some very specific examples in there on how the discount rates and some of the factors on discount rates can be used. So there, for example, in the middle screen is an extract on how the beta in the discount rate is determined. It's not a valuation guide, and this should not be used as the only thing to set your discount rate, but it does give some guidance on the inputs into discount rate. So that's somewhere you want to go and have a look. And then the last page on the right just shows you each chapter has what's called a common errors section. So you can almost use that as a checklist of, have I made these mistakes? Because the common errors are the ones that blow the thing out the water most of the time, but most of them are factored around, are the inputs reasonable and supportable? Have you set the thing up properly? So are you comparing apples with apples? And are your cash flows subject to a budget approval process that's really reasonable? Otherwise, default to long-term growth rates that are externally obtained. I think we would then just kind of remind you of our IFRS corporate reporting experts. I think Dean spoke about the resources earlier, but we've given you a nice little diagram here. There's Dean looking very dapper at the bottom right-hand corner in Melbourne. But we also have Clark and Ashley and Lynn and Aletta and myself sprinkled around the country in terms of advisory partners you can reach out to. And then just on the sustainability reporting, which is a couple of slides later, we do have a multitude of sustainability reporting and sustainability experts that cover core services like carbon, assurance, decarbonization, strategy and transformation. So we've given you some key context there. I won't read them all out. These are the reporting ones. Those are the assurance ones. And they also cover our strategy and transformation people. So there's not just reporting people that you can lean into. But in the first instance, don't be afraid to reach out to the people you know on this webinar. And I think, Dean, at the pace, I've finished exactly at 12. So we'll consider that a job done.
Well done, Kevin. You've done exceptionally well. For a topic that's quite complicated and quite layered, I think you've covered it pretty well. Obviously, there's going to be queries and people have, we might not have addressed, and apologies to those people, we might not have addressed your questions directly, but yeah, we will attempt to address them as we go. But certainly, in terms of topics for future, as Kevin outlined at the start of this webinar, if you've suggested a topic to us, more than happy for you to suggest it again. That's okay. We won't take that as we won't interpret that as rudeness. We'll interpret that as enthusiasm and support. So thanks again, Kevin, for the presentation. It's been really informative, and I hope everyone got something from it. Enjoy your day, everybody.